we've heard a lot about financial stability and non-bank financial intermediaries today. The question that we are facing is, how do we incorporate that information into the measures of systemic risk that we calculate on VLAB all the time? And we're quite cognizant that we've looked that our measures were developed during the financial crisis, but they turned out to be pretty effective in looking at the mini banking crisis of 2023. And we have there are some people who are doing some very interesting research, pushing them back to the 19th century, and it turns out that SRISK is a pretty good measure in those cases. So the question really is, how do we make it better? And there are a couple of things that came out of the mini financial crisis that we think would be good to put into this model. And one of them is a measure of stress leverage. In other words, we produce estimates of what the leverage is using, interestingly, the equity value rather than the accounting value of equity divided by the value of the accounting value of the liabilities. So it's what we call leverage, but after you've stressed a bank, its market cap goes down, and so actually the leverage goes up. And so we now calculate not only the current leverage in the last column, which you see there, but the stress leverage. And so that takes into account what the stress would do. We think that an 8% capital ratio is a sort of a benchmark of what might be sensible. That leads to a 12.5% leverage ratio. And as you can see, all the banks in the top of this list are a little bit leveraged, but under stress, they're a lot more leveraged. So that's already been done. Two things we haven't done yet. First is to correct for uninsured deposits. This turned out to be a big issue in Silicon Valley Bank. And there is some data available. We haven't been able to get a good source to automate it, but that's something we'd like to do. The second thing that we learned from the Silicon Valley crisis is that, well, or actually, this is from the pandemic, during the dash for cash, banks who had a lot of capital commitments from lines of credit that they established with companies turned out to be a lot more expensive than they might have expected, because as soon as the crisis started, a lot of firms drew their lines of credit, and so immediately this became a liability of the bank, where it was just kind of an off-book liability at the beginning. So we would like to have a measure of undrawn lines of credit in there as an additional explanatory variable. We haven't done that yet. What we're closer to doing is trying to incorporate non-bank financial intermediaries, namely the topic of today. And in fact, we include financial firms that are not banks already in our SRISK calculations. We've always had insurance companies. We have some asset managers. We do not have any private credit companies, but that's something we can fix. But the question is, how do we incorporate something like that into our measures of SRISK? And so the idea that we have is that when you do a stress test, we're stressing typically the market. We've also got climate stress tests where we stress the climate factors to see whether those aspects of the bank's balance sheet are sensitive to rising climate risk. And when we do that, we at the same time include the market factor. So we have two betas in this model, returns on the market and on climate. Well, we could do the same thing for non-bank financial intermediaries. We have a beta for the market and a beta for non-financial intermediaries, NBFIs. And so this would say if the financial intermediary gets into trouble, this would be a stress on the bank. One of the complications of thinking about that, of course, is that the bank is lending to the financial intermediaries in many cases. And so when the financial intermediary is in trouble, it means the bank loan is in trouble. But if the bank is in trouble, it may not provide credit to the financial intermediary. So that means the causality could go both either way. And so there's a question of how you interpret this kind of a stress event when we talk about it. And I think actually regressions have a way of interpreting that, which is you think of a regression as a causal relationship, but it isn't necessarily. It's a question of conditional on what happens to the right-hand side variable. What's the best estimate of what the left-hand side variable is? So it's actually a co-movement thing. When the financial intermediary is in trouble, does the bank tend to be in trouble? And when the financial intermediary is doing well, is the bank doing well? And so that's not a causal. So that's the sense in which I'd like to interpret what I'm just going to show you. We've done it with the dynamic conditional beta method that we have in the website. This is for 4 different categories of financial intermediaries, all asking what's the Goldman Sachs beta on these financial intermediaries. So we have insurance companies, asset managers, real estate investment trusts, and private credit. So we have listed versions of all 4 of these. And these are equal weighted averages of, 20 to 40 firms in each case. This is just a first cut at it. And so I'm just kind of showing you what we might do on this, what we have done. You look at these pictures and you say, pretty noisy. The only main thing you can see is, well, here's 0. So it looks like in the private credit, they're almost always positive. When you look at real estate, you see it's positive and negative, positive, negative. It's not really clear that what we're seeing is really that significant. Insurance is always positive, and asset management looks like it's positive. Instead of looking at all this time series, let's look at them just as a fixed regression. So here we have a bunch of banks. You probably can't see this, but the largest banks are in the top, and then we've got a bunch of sort of mid-sized banks down here. What we're regressing them on is a market. So this is the market beta, and we're going to do it as a stepwise regression because there's so much multilinearity between these different things. So we run the regression on the market beta, then we regress the residuals on insurance, asset, REIT, and private credit. Well, there are kind of a lot of things in there, but the ones that are significant I've put in red. And what you see is that a lot of the insurance betas are red, a lot of the private credit betas are red, and none of the other 2. So it looks like the non-bank financial intermediaries that are most important from the financial stability point of view are really insurers and private credit. We had a meeting on insurers last year. We do private credit as one of the key things we talked about today. These are are important ways that I think non-bank financial intermediaries can be incorporated into understanding financial stability. And this is just touching the beginning of this, but we'd like to be able to do this a lot more systematically. So that's what I wanted to show you.
Great. Well, it's been a long day. Thank you all for coming.